Hello, everyone. I hope you had a good trading week so far. As you know, yesterday the Federal Reserve increased their rates by 75 points, which affect the market today. So let's go to the charts and see how this could affect the NASDAQ 100 and the tech sector. I asked you a question regarding one passage yesterday, and I asked you what is the most important thing in that passage, and that the answer was context. So the context has been changed from a quantitative easing to quantitative tightening. Let's first go to the rates, Federal Reserve Fund rates, and in the past few decades, see what is the chart, and then we are going to talk about it more. So if you are looking at here, you see this chart. This is the effective federal funds rate. During the past bullish market, as you can see after 2009, between 2009 and 2020, we see in most of the time the rate was near zero. Then you see after 2015 is slightly increased to 2.5, and then when the pandemic occurred, it moved to the zero once again. Now we are actually around here, a sharp increase. If you are looking, for example, between 2010 and 2015, we see a surge here. So this is when we are talking about the context. The most important factor one of the most important factor could be the Federal Reserve Fund rate. So now you have a clear idea about what is the context. So when we say the context, one of the most important things that we are talking about is the inflation rate and Federal Reserve rate. So this is what I like to show you before we go to the NASDAQ chart once again. If you are looking at the NASDAQ chart, here in November, this is the first time that Federal Reserve Chair Jerome Powell talking about the possibility of quantitative tightening programs. Market started to shake after that, and then by the beginning of 2022, we see the decline started. So if you are looking at this chart, you see the bearish channel. The bearish channel, the NASDAQ 100 moves in this channel for a while until this part when it break below the lower border of this channel, moved upward. This is what we usually call a relief rally, or this is what we call a relief rally. It starts near the lower border of a bearish channel and move to the upward, cannot break above the previous high, and then extend to the lower prices, make lower high and lower low. So if you are looking at this part, we had a lower high also here, and we make a lower low. And as most of you know, the definition of a bearish trend is that we see lower high, lower low. So this is it. Then yesterday we see a pullback to the lower border, and today we break below the previous low. Actually, we had these three candle together, we call it a pivot point, a true price pivot point. The middle candle has the lower low in comparison to the previous and the next candle, and this one close above the high of this. This is a true pivot point. So if you are looking, we almost touch the lower border of this and break below the previous low, which neutralize this pivot. If we close below this, we see this. So another important factor to evaluate is that if we are looking at the chart from April today up to today, we see this channel as well. So what is the importance of this channel? For any channel, to draw any channel, you need at least 3 pivot points. So this is the new channel. The difference between this new channel with the previous one is that the angle of this is much sharper than the previous one, which indicates that we are experiencing this could be wave 3 of the bearish market. So we can call this wave 1, this wave 2, and now we are experiencing the wave 3. The wave 3 usually is the most strong one and could last more than the duration of the wave 1, and also it extends lower, and the move is much sharper. As you can see, this move is much sharper of this move. So if we are looking at this as a bearish market, there could be a wave 4 or wave 5 after the wave 3 is finished. So for the wave 3, we can have 2 possible targets. These 2 possible targets could be this target, which is the worst case scenario, and by the August, it could drag down the Nasdaq to 9,000 territory. Or we can have a milder situation, which ends around here by the end of the June, and we see something around another 5% decline to the 1050 or between 10 to 1050. So this is a milder situation, and this one is like the worst case scenario that we can have as the target for this wave 3. So this is one way to evaluate this chart. However, we can have another picture and another type of analysis, which could help us to determine where the market is going or what are the other possibilities that we can face. So one way to do analysis in the market is Wyckoff method. Wyckoff, he was a very famous technical analyst who started working around 1920. He was like 15 years old when he started working in a broker, and by age of 2021, he was the head of their broker firm, which is phenomenal. So if you are looking at this, and we want to do Wyckoff method analysis, this could be considered as a distribution phase after a very long bullish market. So this could be considered as a distribution phase. To have a better idea about a distribution phase, you can see the similarity between this picture and this is from Investopedia. So if you are looking at this, this is like exact distribution phase, followed by correction. These corrections also called redistribution phase. So usually after a bullish run, if we have a distribution phase, then we have the markdown followed. In the markdown phase, we see redistribution phase like this and like this. So there are some different characteristics that makes the redistribution phase different from accumulation phase. The most significant one actually is the redistribution phase are shorter are shorter from time frame perspective in comparison to the accumulation phase. So this, if you are looking at this, we have some redistribution phase during the markdowns in Nasdaq. So if you are looking at this as a distribution, then this is going to be the markdown phase. So this could be considered as a redistribution phase. If it is going to be an accumulation phase, because we are already down like 32% from year to date, and if we are looking at the distance from top, we are now 33, almost 34% away from top. The bearish market usually tends to correct around 28%. So in the past 70 years. So we are almost there. So this could be a redistribution phase because the duration was short. But if we see something like this happen in the next couple of months, we move around here and then the reversal, which is unlikely at this time. Because as we said, the context has been changed a lot. So in the future months and the months to come, Fed will increase the interest rate, and there will be higher possibility for going lower, as I showed in the previous picture. So we consider this as a redistribution, not an accumulation phase for this time. If we want to compare the market with the 2008 situation, which I believe there is very likely, this is a replication of 2008 market and what happened in 2008. If you are looking at this, I actually corrected this form and this pattern so you can see it much better. So if you see this shape of collapse, we can see that this time maybe we are in some part of here. Maybe we are in some part of this leg, because although the formation is the same, but the duration and everything, it looks like it happens much faster. So if we are looking at the first two waves, it was almost the same. This part actually we can consider this as this, and we consider this as this. So we must be here. So and if we are here, the more the more decline could be very probable. And if you are looking, it usually go sideways at the end of wave 5 for a while before going upward. So by this analysis, if the duration, however, However, I believe the duration could be somewhere sooner than next April. But this bearish market could last for a year or so. On average, in the past 70 years, on average, we expect the bearish market to end before 18 months. So I believe because of the quantitative trading methods and the faster pace of the market in the recent years, we should expect something more something faster. So this is another thing that we should keep in mind. I expect it to finish before 18 months. So and we are now experiencing the fastest part. The wave fifths could be a sideway and a much complex wave. So this is my prediction for Nasdaq. I believe the lower numbers in the coming months is very possible. However, there is one thing that I want you to keep in mind. 54% of the biggest green candle ever happened during the bearish market. It must be interesting for you. I repeat once again, 54% of the longest green candles happened during the bearish market. For the first time I saw this data, I was shocked because usually you expect the longer green candles to happen during the bullish market where the market is strong, but it's not like this. And this is data. This is based on data of the past 70 years. So if you see the market in the past few weeks, or if you see it here, you see that these long candles, for example, like these long candles that we face here, or here, you can't see anything like that here during the bullish market. And this is interesting. Even if you are looking at the market crash during the pandemic, if you look at the size of the green candles, they are much bigger than the market after that, which was a bullish market. So keep in mind, for day traders and for swing traders, there could always be opportunities. But for those who are long-term investors, I believe they must wait. They must wait. They can find much lower prices to enter the market. At this time, cash could be the best option. Why cash could be the best option? Because if you are looking at the level that we are, it's like minus 33% below the top, and this this makes it very hard to open some short position around here, and this makes it very tricky, and the risk to reward ratio is not that good. One other thing that most of you like to know, I think, could be the crypto market situation. If we are looking at the crypto market situation, this is like the monthly. I believe the crypto market could go down at least another 25% from here. At least. What I say, at least. I believe in a worst case scenario, it could even go down to below $500 billion market cap, which is 1/6 of that 3 trillion, which which already actually we are down like more than 66%, or now it could be around, if you are looking at this, it is now 72%. Yeah, we are down almost 72% from the top, which makes it very unlikely to repeat this top in near future. Why? Because the context has been changed. If you are looking at the crypto market started around here by Bitcoin, and then the other altcoins, they actually start here during the free money era, and now there is no free money and there is no quantitative easing program. So this affects the speculative asset like Bitcoin and other cryptocurrencies the most. So while so many people think cryptocurrencies or Bitcoin are a good hedge against inflation, I really doubt it, because at this time, if you are looking at the cryptocurrencies, they experience 72% drop during the past 8 months. The inflation was peaking, and these assets losing their value. So I believe they are not a good hedge against inflation. If you are looking at the past 1 or 2 decades, yes, they experienced a very sharp upward move, but I would rather to see that not as investment, but they are, to me, they are speculative assets that you buy them, and you expect someone else buying it at higher prices in the near future. So if you are looking at this, you can clearly see when some asset losing 72% of its value in 7 to 8 months, this cannot be considered as a safe haven against inflation, because in the past 8 months, inflation soars, but this asset declines. So from technical point of view and from psychological point of view, they are not a good hedge against inflation unless you buy them a decade ago and hold them and you are still happy with it. But anywhere since January 2021, whoever who bought these types of assets could be in huge loss. Even if you are looking at this, Bitcoin used to be around 20,000 in 2017, 18. So the price is still the same after 5 years. And this cannot be considered as a good investment in comparison even to the stock market. When you compare the Bitcoin of 2017, 18 to when it was 20K, now it is almost at the same price. So be careful with cryptocurrencies as well, because they can lose at least another 25% of their value. And when I say 25% of their value, I mean Bitcoin and Ethereum, which are the biggest ones. However, Ethereum has shown that in the past, it lost almost 94% of its value in the corrections or the bearish trend. So this was the analysis of Nasdaq. I think in a good case, we are going down another 5-6%. And in a worst case, there is a possibility that we go down another 18 to 20% in the coming months. We should wait for bounces and then short, or crossing below the previous support, which is right here. However, I think I will try to publish analysis about good opportunities if I see any in the coming days. Thank you so much. Please ask your question about this analysis in the chat rooms. I will try to answer all of them. And please try to ask questions that you can think your fellow traders could also benefit from it.